Morning everyone. Today I am going to give presentation on Stochastic Oscillator. Myself Shubhi Varshney and I am from Machine Learning and Deep Learning Group. Before diving deep into the presentation, let us have an overview of what are the table of contents. First is introduction, followed by the purpose, then how this stochastic oscillator works, followed by the concept of overbought and oversold, then crossover, followed by divergence. What is a stochastic oscillator? So a stochastic oscillator is a technical analysis tool which is used in trading and investing to help identify the potential overbought or oversold conditions in a financial market. It was developed by George C. Lane in the 1950s and it is a popular and important indicator. The stochastic oscillators measure the momentum of an asset's price to determine the trends and predict the reversals. Stochastic oscillators measure recent prices on a scale of 0 to 100 as shown in the image alongside. Here the conditions are from 0 to 100 where the readings or measurements above the level of 80 are considered as overbought conditions and the readings measurements below the level of 20 are considered as oversold conditions. Now the purpose of stochastic oscillator. The purpose of stochastic oscillators is to help traders and investors identify the potential overbought or oversold conditions in a market. Further, analyzing the relationship between the stock's current closing price and its recent price range, the stochastic oscillator provides a numerical value between 0 and 100. It is a modified version of RSI strength, which is known as Relative Strength Index. Additionally, the stochastic oscillator can be a useful tool for traders looking for potential entry and exit point in the market, as well as for confirming trends and momentums. Now, the stochastic oscillator works well with share market, future market, commodity market, as well as forex market. It is beneficial for both short-term and long-term traders. Now, how does stochastic oscillator works? The stochastic oscillator works by comparing stock's current price to its price range over a specific period of time, followed by the generation of a numeric value between 0 and 100, which is used to identify the potential overbought and oversold conditions in the market. There are two main lines in a stochastic oscillator, which are indicated by %K line and %D line. Now, what is %K line? The %K line is the primary line in the stochastic oscillator, which represents the current position of the closing price relative to the recent price range. The %K line is more sensitive to short-term price movements and shows the fluctuations very rapidly. The formula to calculate %K is denoted in the picture alongside. One can see the %K can be calculated by close subtracted by low n divided by high n minus low n, where the close represents the current closing price, the low n represents the lowest price in the specific period of time, the high n represents the highest closing price in the particular period of time, and the low n represents the lowest price in the specific period of time, and n represents the period of time. By default, it is taken as 14 days. Then this whole value is multiplied by 100 to get a percentage between 0 and 100. The second important line is %D line. The %D line is the moving average of %K line and it is typically calculated by over a specific period of number of periods. The most common period used is 3. The formula to calculate %D is usually the moving average of the %K values over a specific period. Here is the formula to calculate the %D line. The %D line provides a smooth version of %K line, which helps us to filter out the short-term fluctuations and provides us with a broader perspective of price movement. The %D line is less responsive to rapid lines as compared to %K line. The interaction between the %K and %D line is a key aspect to understanding and interpret the stochastic oscillator signals. Now, the stochastic oscillator signals are displayed by two main lines. The first is %K line and the second is %D line. The %K line is also known as fast line as it is quite rapid to fluctuations and is generally denoted by green color, followed by %D line, which is a slow line as it is less responsive to fluctuations and is generally denoted by red color. The colors may change. Now let us understand the basic structure of stochastic oscillator. The basic structure of stochastic oscillator is from 0 to 100. Here are the price moments and here's the stochastic oscillator indicator. There are three main levels in this at 20, 50 and 80. When the stochastic oscillator is below the level of 20, that condition is considered as oversold. And when the stochastic oscillator is above the 80, the condition is considered as overbought. The area between these levels of 0 to 50 is considered as bearish zone, and the area between 50 to 100 is considered as bullish zone. The bearish zone is indicated by a red color, whereas bullish zone is indicated by a green color. Now let us understand the concept of overbought and oversold. What is overbought? An asset or a stock is considered overbought when its price has risen significantly and quickly, potentially to a level that is unsustainable in a short term. For example, let us take an example of COVID-19. In March 2020, when the COVID first hit the world, the demand of masks was significantly high, which led to the prices of the mask to a very high level. That condition for the commodity of mask is known as overbought. Conversely, an asset or stock is considered oversold when its price has declined significantly and rapidly, potentially to a level that is lower than its true value or justified by the market condition. To understand the concept of oversold better, let us take the real life example of tomatoes. We all know that once the tomatoes had a price of 200 to 250 rupees per kg, but as the supply got much and there was excessive supply for the same tomatoes, their price declined significantly and rapidly, potentially to a level that the true value of tomato was not justified and the price was merely 5 rupees kg to 3 rupees kg. In this situation, this condition is known as oversold condition. In simpler terms, let us understand the overbought condition as the condition where the asset or commodity has excessive demand in the market, or oversold condition as the commodity or stock has an excessive supply in the market. In this graph, when the stochastic oscillator has a level of above 80 and then it goes down, this is known as overbought condition, and this when the stochastic indicator is below 20, it is considered as a condition of oversold. What are crossovers? So crossover in stochastic oscillator refers to a specific event when the two main lines of the oscillator, the %K line and %D line, intersect or cross each other. A bullish crossover occurs when the %K line crosses above the %D line. One can see in this image, this is known as positive crossover or bullish crossover when the %K line crosses the %D line in an upward trend. Now this is often interpreted as a potential buy signal. A trader or an investor can buy a particular stock. It suggests that the short-term momentum is shifting positively. This means that the market is growing in an upward direction and may indicate a potential upward price movement, indicating a profit for a trader or investor. Similarly, a bearish crossover or a negative crossover occurs when the %D line crosses the %K line, or one can say the %K line crosses the %D line in a downward direction. This is often interpreted as potential sell signal. The investor or the trader must sell his stock so as to ensure the minimum loss in this particular market conditions. It suggests that the short-term momentum is shifting negatively in the downward direction and the price may decrease down in the downward direction. Now let us understand the stochastic oscillators using these graphs. Now when to buy or when to sell, how these stochastic oscillator gives us indication of the very same. So if the %K line or %D line are having a positive crossover below the level of 20 or nearby the level of 20, here it is below the level of 20 and here it is nearby 20, this indicates a buying signal. Once it has crossed, then the trader or investor must buy the stocks for a maximum profit. Similarly, if the %K line or %D line have a negative crossover below the level of 80 or above the level of 80, it indicates a selling signal. Now let us understand long bullish trend and long bearish trend. So if this %K line and %D line have a crossover in the positive crossover between the level of 50 and 100, it indicates long bullish trend, indicating profit. Here the prices are in an uptrend moment, and once the prices cross the level of 80, it indicates that the prices are indicating a strong hold on the profit side. Similarly, if the %K line and %D line have a negative crossover below the level of 50 and between the level of 0 to 50 going in a downward direction, it indicates a long bearish trend, where after the once that %K line and %D line crosses the level of 20, the seller must consider the condition as an oversold, and here the buyer or trader must consider the condition as overbought. Now, just like we have the chart patterns in price movements, we have chart patterns in stochastic oscillator also. The point to remember here that here the chart patterns are being drawn by the stochastic oscillator indicator, not by the price movements. So there are two types of basic patterns. The first is a double top and second is a double bottom. So what is a double top? A double top pattern in a stochastic oscillator is a technical analysis signal that can indicate a potential reversal in an uptrend. It occurs when a %K line reaches a high level, then pulls back and then again reaches a similar high level before starting to decline. It resembles an alphabetical letter M. One can see in this strong bearish trend a double top. Here the %K line has once gone up and then at a similar level, followed by a decline, and it is showing an alphabetical letter M, which is a double top chart pattern. The second type of common pattern is a double bottom. A double bottom pattern in a stochastic oscillator is a technical analysis signal that can indicate potential reversal in a downtrend. Here we had an uptrend and then it had a reversal to a downtrend. In a double bottom, we have a downtrend which has a reversal of an uptrend. It occurs when the %K line reaches a low level, then it rises up and subsequently reaches a similar low level again before rising up. It resembles the alphabetical letter W. Now what is divergence? So divergence in a stochastic oscillator is a significant technical analysis tool and which occurs when the price action of an asset and the values of the stochastic oscillator move in opposite direction. For example, when the prices are showing a profit but the stochastic oscillator is showing a loss, it is known as divergence. Now there are two types of divergence, bullish and bearish divergence. The bullish divergence occurs when the price of an asset forms lower lows, but the stochastic oscillator forms higher lows. For example, one can see here the bullish divergence. The prices are showing the lower lows. These are the lower lows. These are showing a downtrend, whereas the stochastic oscillator is showing an uptrend. After some time, it is showing an uptrend, where if we get a bullish candlestick pattern, it is indicating in the trend reversal. Similarly, bearish divergence. A bearish divergence occurs when the price of an asset forms higher highs. One can see the price chart, it is showing higher highs, it is an uptrend, whereas the stochastic oscillator is forming lower highs. It is going in the negative crossover. It is showing a positive crossover here, but it is showing a negative crossover. Here one can see a bearish candlestick pattern here and bullish candlestick pattern on this side. Now we have already learned quite a lot about theory. Let us see all this in a small practical implementation. To have a better understanding of the very same, I have used the concept and understanding of the stochastic oscillator using TradingView. In this, one can see that I have used the HDFC Bank stock market dataset. Here the data is provided and I am using for 1 month. I have used the stochastic oscillator this side and I have plotted the very same using here, typing here stochastic, and here from here I have clicked it and it has appeared on my lower bottom. These are the candlestick patterns. These are the volumes for the particular day or particular time, specific period of time, followed by the stochastic oscillator. Here the levels are shown as 0, 40, 80. One can see the levels below 20 are considered as oversold and above 80 are considered as overbought. Let us see the very same for 5 days. So one can see the blue one is %K line and the orange one is %D line. So here if we zoom it up further, one can see a positive crossover this side and a negative crossover this side. This is all for the practical implementation. Let us go back to the presentation. Let us understand the limitations of stochastic oscillator. While the stochastic oscillator is a valuable tool in technical analysis, it surely has several limitations that the traders should be very aware of. The first is the lagging indicator. The stochastic oscillator is based on historical price data and can lag behind rapid price change. This means that by the time a signal is generated, the market may have moved forward and the conditions may have already changed, which can lead to the missing of opportunities or late entries or exits. The second limitation is lack of context. The stochastic oscillator provides information about the internal momentum of the prices or stock, but it does not take into account the broader information such as market factors, news events, or fundamental analysis. The third limitation is subject to market noise. Like many other technical indicators, the stochastic oscillator can also be affected by market noise, which refers to short-term or random price fluctuations. The last and foremost limitation is no guaranteed success. While the stochastic oscillator can surely provide valuable insight, it is not a guarantee of profitable trading. The market conditions can change very rapidly and unexpected events can take place which can impact the price movements. Conclusion. In conclusion, I would like to say that stochastic oscillator is a widely used analysis tool which can provide valuable insight into potential overbought and oversold conditions. Traders often use the stochastic oscillator to identify the potential entry and exit points for themselves. They confirm the trend and assess the momentum. However, it is very important to note that the oscillator has itself quite limitations, including the potential for false signals, lagging indicators, and its susceptibility to market noise. To maximize the effectiveness of stochastic oscillator, the traders must use it in conjunction with the other form of analysis to implement the risk management strategies and consider the broader market context. Here are the references from where I took help to make this presentation more informative. Thank you.